So, welcome. Go ahead and go to the next slide there, Terry. I want to, on behalf of ACG Kentucky, I want to welcome everybody to our first ever virtual event. This is one of two that we'll have here in the spring of 2020. Again, my name is Brad Smith. I have the honor of serving as a chapter president right now. So go ahead, Terry. Next slide. For those that have been with us before, you're familiar with these names, longtime supporters of the chapter, allowing us to continue to do the things we do in the market to foster the ecosystem of private equity across the region. And they're joined by some others, both a table sponsor in this day and time, virtual tables, and then our corporate sponsors of with Hillier Lyons Baird and Frost Brown Todd, our educational sponsor, longtime supporter with College of Business at U of L, and then our friends at Louisville Business First, who have been our longtime media partners. So we've scheduled this event as our first virtual event. We'll have another virtual event come May 12th. Most likely, the timing of that event will shift. It'll be on the 12th. Most likely, it will be from 1 to 2, like today's event is. But it'll feature who we had planned, and that's Terry Gill from Access Ventures and Jackson Andrews from Endeavor. And we'll probably pivot a little bit from their original topic and kind of put it in today's context. But looking forward to having Terry and Jackson join us and share their insights at how it impacts the private equity across the region. The other thing, just before we jump into today's webinar, um, in June every year we co-host the Mid-South Capital Connection with our friends in Tennessee. Again, that was scheduled to happen in June this year in Nashville, Tennessee. Right now, that event's been put on hold. The June date will not happen. We're in the process with the planning committee to look at whether there is an opportunity to reschedule that event for the fall, still to be in Nashville, but that's yet to be determined. So be on the lookout for more information. Hopefully by May 12th, we'll kind of have a firm direction on that event. It's always a great event, so we're hopeful that we can make it work, but a lot of moving parts, as you all can appreciate in your own businesses, trying to juggle schedules and make things work with today's constraints. So let's jump into today's session. This slide just kind of gives you a feel for how we're going to go about today. We've got a panel of representing kind of board and sponsors. They're going to share their insights and views from their seat in the market as it relates to current events and maybe what they see going out through the rest of 2020, maybe into 2021, specifically in the realm of kind of the private equity space that we foster the ecosystem around. They're going to each do about 10 minutes from their view. As they do that, if there's questions that come up, if you'll just drop those into the chat box, which is down across the bottom. For most of you, you probably have been using Zoom. You're familiar with that feature. We'll compile those questions when we get to the end of the three opening statement presentations. Then we'll work through the chat room, and then we'll also have a time for live Q&A. If you have questions at that point, if you'll just kind of hit the raise the hand feature within Zoom, then Terry will facilitate the hosting of that, and we'll call on you and ask you to unmute yourself and ask somebody on the panel a direct question, and we'll go from there. And again, we'll keep our event to 2 o'clock. It'll be a hard stop for us as we go through. So you'll see our panelists here, and we're going to go in alpha order. Ken Berryman was the founder of our chapter. Ken's with Weller Equity, so he'll give us that perspective. Darren's been Darren McCauley with Old National Bank's been extremely busy with all of the PPP program and the EIDL program, and so he'll give us a perspective from the banking community. And then Mark Summer representing Frost Brown Todd and give us a perspective from the attorneys and kind of what they're seeing in the market and where they see it going into the rest of 2020 into 2021. So I'll let each of them maybe give a little broader bio of themselves if they choose, but I'm going to turn it over to Ken Berryman at this point, and he's going to kick off the panel. So, Ken, off to you.
Thanks, Brad. Can y'all hear me?
Ken.
Good. Well, thanks everybody for being here today. Really appreciate it. Hope you all are well and safe. And we hope to give you a little bit of an overview of what's happening in the marketplace. You're probably all familiar with the PPP program, basically enabling companies with less than 500 employees to apply for what are forgivable loans up to $2 million, I think. Maybe it's $10 million. But anyway, it's based on your average payroll, and you basically need to spend that money on payroll. 25% can be spent on other things like rent and some mortgage interest. But essentially, it's there to let the companies continue to employ their people, which we are going to do. So from an operating perspective, we have shifted all of our focus towards the portfolio companies. In our case, they're manufacturing and distribution primarily. They have been deemed essential businesses, fortunately for us. So people are coming to work. We're dealing with the absenteeism that comes with people who are either sick or afraid to come to work. Um, and we need to be flexible for those folks. Um, uh, the next step, of course, is making sure we have business to produce, and we're doing that. Fortunately for us, our demand is remaining relatively high. So the crux of the issue, now that we're kind of through the initial shock of it, is trying to figure out what's going to happen in the second half of the year. That is an unknowable question, or the answer is unknowable. We're going to see how fast the world comes back to life, and what happens with our orders. But getting through the next 8 weeks with the PPP money is one thing. What's going to happen after that is completely another thing. So as it relates to the M&A market, we're not seeing any deal flow. Investment bankers have pretty much shut down. It's not a good time to bring deals to market. As you can expect, we do have a couple of deals that were in process before the outbreak, and we're still working on those deals. But I think if you were out there trying to source private equity capital right now, you'd be in a tough spot. I don't think the lenders out there, the private lenders, not the banks, but the PE lenders are licking their wounds. They're testing their portfolios. To try to get new money out of them would be very difficult. If you're selling a business, as I say, this is not the optimal time to get pricing. You have missed the best opportunity to sell your business if you haven't done it by now. I do believe the economy will come back. It'll come back strong, but I think we've certainly seen the peak in pricing that we're going to see for this cycle. I still think you can get a fair price for your business after the fact, but with credit is going to be harder to get, and I think pricing is going to show the impact of that as well. So I guess just for my recap, I'd say we're focused on our businesses. We're focused on watching the economy and seeing how it comes back. We're busy, looking at ways to improve the businesses we have with add-on acquisitions. Those tend to be safer and easier to accomplish. And we're just trying to stay well.
Thanks, Ken. Might turn it now to Darren McCauley with Old National to kind of give us a view from your seat, Darren.
All right. Thanks, Brad. I appreciate Ken's comments. I think from the banking standpoint, we started March, if you will, in what I would call a loan deferral time frame, when clients were now starting to get shut down in various areas, and/or demand was falling off before this whole SBA PPP or Trump money started coming out. And you were taking a pretty hard look. Banks were taking a pretty hard look at clients on where we could give some deferral forgiveness, if you will, 30, 60, 90, 120 days. And where those merits were when the onslaught of the PPP program came on. And I would say for most banks, it has swallowed all facets of the bank for probably 10 to 12 days. Most are coming up now. However, it appears that a new 250 billion is going to hit the market for all of us, maybe tomorrow or the next couple of days, in which those who were 1099 and sole proprietors who got pushed off a week from the first Friday to the second Friday before they could apply were some of the primary hardest hits who didn't get these loan programs. The primary fun of all that was the rules were being made up as the game was being played. So as you're starting to hear now about the forgiveness rules, those rules and the rumors and facts and how that all is going to be established is yet to be seen, and the timing and so forth. So the banks kind of started taking their eyes on, or putting their eyes on their clients on who they could defer, get them over this hump to now being the SBA's provider of funds to small companies. Um, it's been an interesting time frame. One of the tasks that I got the opportunity for the bank to start this year as we reorganized was to turn a lot of my time into multi-bank deals. I'd like to call it a syndications desk, but when you're a $20 billion bank, it's more of a multi-bank club deals type structure. But what I found in the fact that most of the banks do have some strong clients out there who are still out in the market. You saw a lot of liquidity financing going on in early March, prepping for first quarter end. Many banks were brought to the table just to provide liquidity for clients as they went into first quarter. And I've talked to several banks, primarily through our footprint, which I would call the Midwest, Wisconsin and Minneapolis being on the northwest kind of side of our footprint. But a lot of the banks have become a little more apprehensive, a little more client-centric, footprint-centric, kind of looking in market at known entities, making sure they're really taking care of their clients um, first. And you saw that primarily in the PPP program, as non-clients were being, for lack of a better term, shunned from the banks to go to where their primary accounts were to get those loans. As banks like ourselves, I know our first quarter earning call was Monday. I think we announced almost 6,000 applications at 1.33435 billion. So you think about a $20 billion bank who's doing about $1.3 billion in loans in maybe in a less than a month time frame. As I've listened in and signed off, and I've listened in on loan committees and signed off on some deals, what you're starting to see is kind of a lot of homework being asked of the lenders out there. So as Ken talks about, when we start coming out of this, what's it going to look like in the merger and acquisition side? And I don't think PE firms are going to be grossly different than the private than us commercial private type banks, in the fact that there's going to be a lot of homework done, a lot of pro forma and projections, starting to look at what tolerances the company has or had. A lot of credence being put on where they were coming into this to see where they will be coming out of it. And probably a lot of you've heard this new term, or at least a new term I think that's going to become popular. Forget about EBITDA or EBITDAR. There's going to be an EBITDAC, if you will, or a C on the end, which is an add back for kind of the coronavirus one times that can you get comfortable with, like you do in an M&A type transaction. How much of that one time can you add back into the real kind of ongoing cash flow? So as I give you a picture of maybe some of the clients I've seen, whether it's some convenience store types or out there who've really seen volumes on gasoline go down but margins go long, and maybe their inside sales get a little soft, their numbers aren't that far off. Got a manufacturer kind of on in the HVAC, appliance, and car side. And until maybe this last week, really hadn't seen much of an offset. But now that you've seen the auto manufacturers kind of shut down for a little bit, they're starting to see some pushback. A public company I could talk about is maybe a Texas Roadhouse. They went out in the market and drew down on all their liquidity. They've really, I think, if you've seen their stores at least locally, they have really gotten the drive-through process down, and it looks like it'll be interesting to see what their sales look like going forward. I can tell you I was in the middle of an M&A type deal in the distilling business, and all their committed capital went away almost as quickly as this shutdown went on. So they were ready to do a deal. They had private capital equity put in place. They were looking to us to do some lending, really too small to be a PE, and it just kind of fell apart. To Ken's point, I think it comes back. When, it'll be interesting. The only other comment I'll make, and then I'll kind of turn it over to Mark, is interest rates have been almost as crazy as oil prices. And some of that settled down as you saw the Fed practically drop rates to zero. The banks can borrow at about a quarter. One of the target rates that we may see coming out of all this is that, the secured overnight financing rate, or SOFR. And today, if you looked at 1 month LIBOR, it's in that 60 to 65 range. The SOFR is under 5 basis points. I think it's at 2 or 3 basis points. So it's going to be interesting to see as rates become interesting, if you will, in the way they've moved around, what the LIBOR change will be coming forward, how we come out of this. I'm helping to start the EBITDAC terminology, which I think is going to be one that all of us are going to start talking about as we look at go forward numbers and merger and acquisition deals. So with that, I'll kind of turn it over, Brad.
Thanks, Darren. Great update from that. And then last but not least is Mark talking about from a legal perspective. So Mark, the floor is yours.
Good. Thanks, everyone. So my focus at FBT is tax. So I lead our tax and employee benefits and estate planning practice group. So I would second chair, for example, all of our PE attorneys from the federal or the state perspective. And it's really what I want to talk about today is your private business partner, your uncle. Tax, in go-go times, tax is usually an afterthought. You deal with it, you expect you have to pay it, you factor it into your valuations, you move on, you do your deal. In a recessionary moment, in particular, one that involves cash flow concerns or liquidity concerns, tax takes on a new importance. So this is my third recession. We're all pretty similar in demographics on this call. And I want to share with the viewers what I recall from our prior two major recessions, right? So the first one is you're going to have tax activity like you've not seen in years. What do I mean by that? You're going to have a combination of legislative or administrative or regulatory action, which we have seen, right? In the last 4 weeks, we've seen more tax acts, more tax action than at any other point in my 32-year career, all right? It is literally the wild, wild west when you look at state, local tax and then layer on the federal. I'll come back and talk a little bit more in detail about some of the relevant federal provisions for this viewership. But as it relates to uncertainty, ambiguity, trepidation, and in some instances fear, I would say what we have right now is a perfect storm, the likes of which I've never seen in my career. So what's that mean for business? What's it mean for PE, for portfolio companies and the like? It means increased audit activity. It's coming. All right? It means tax increases. It's coming. It means administrative discretion, whereas over the last 10 years in a moving and booming economy, government was more inclined to facilitate accommodation to further business I suggest that they will be less accommodating or less inclined to facilitate accommodating business, such as private letter rulings that might be needed in order to lock down an open issue in an acquisition or a sale, etc. So we have to keep that in mind. Cash taxes, obviously, cash is king. Some taxes are accounting taxes. Some taxes are just a hassle, for lack of a better term. We have to comply with it. We collect it and remit it. And then others are cash taxes. That's going to be a huge driver going forward as well. I would look for more increased audit enforcement at the federal level for a multitude of reasons, only one of which is the recent ambiguous language. It's just one of our commentators spoke already as to making up the rules while they're playing the game. I don't even know if that fairly communicates what they've been doing. I think they're doing a little bit of that. I think it's aspirational. Then I think they're changing the rules after you walk into the dugout, after you had your at-bat. Talking about drinking from a fire hose, taxpayers and advisors, attorneys, analysts, planners, underwriters, bankers, go on, accountants. It's been unprecedented, and it will continue to be unprecedented. I also think you're going to see some major blowback coming to small publicly traded operations. I just was looking at a CNBC report that came out a little bit ago. So there was $349 billion allocated in the CARES Act to the PPP program, right? So that's the famous forgivable loan program. We had some commentary on it earlier. It ran out of money. It was a fire sale. They're going to pump another $200 billion or thereabouts into the program this week, we hope. Out of the $349 billion, at least $243.4 million of that went to publicly traded companies. So let's just triple that. Let's call it, several quintuple it. Several billion went to publicly traded. We've already been reading about the blowback on brands and consumer portfolios because they've taken this money. I ask everyone, is this kind of like the TARP money, where you got to take it, you have to do it, but you don't really need it, but you're worried about your shareholders, but when you do it, do you get blowback? I think these kinds of intangible issues are going to be walking forward over the next 6 to 10 months in major business, PE included. So with that, let me pivot real quick. A couple of the tax issues that I think are worthy for this group, I'd be remiss not to talk about that. We mentioned the PPP. We've all read the direct payment program, the checks in the mail from the Treasury Department. We've heard about a lot of the employment tax credits. We read, these are headlines every day for the last 30 days in Wall Street, Bloomberg, wherever you get your business news. A couple of the things that I think are critical to this group assembled, the NOL carryback provisions. I think the relaxation of the NOL carryback provisions for C Corps is major. It's just simply huge, if only because you recognize that a loss in the year 2018 or 2019 or 2020 would have a 21% tax rate value, right? And if you can carry it back pre-18, in theory could have and would have a 35% tax rate value. So not double, but almost double, right? So that's a key issue. But I want to caution everyone, that's where the easy part ends. The nuances and the levels of complexity associated with simply carrying back an NOL in order to exploit that rate differential, that which was the policy of Congress, exploit the rate differential and get cash to the businesses. That little act creates a multitude of other potential issues for federal tax and state tax purposes. That's a key one. The 80% limit on utilizing losses has been relaxed for the years 2018 through 2020. That's a key issue in the PE space. The interest deductibility limit that was put in place fourth quarter 2017, that has been raised from a 30% calculus to effectively a 50% calculus. That'll be significant during the year 2020, obviously, because of the significant amount of debt. This is a key one, obviously, for portfolio companies in the PE space. The pass-through loss rules for S corps and partnerships has been relaxed greatly under the CARES Act. The $250,000 per return or $500,000 per married filing joint return. These limits, which were put in place during the Trump Tax Act of Q4 17, were relaxed. That's huge. And so you could go back to 1/1/2018 and file a refund claim or an amended return and try to exploit that loss if you were stuck in a position almost being whipsawed where you were maxing out your losses and having to carry the rest of them forward. I'll end on a little prognostication, since we all seem to be living Groundhog Day every day in our home offices. What are we going to look for in taxes as to the legislative or the regulatory action? I've talked about enforcement. I've talked about accommodation. That's much more administrative. What do I see coming out? I see a tightening of the unlimited pass-through loss provision. I think that's a political hot potato. I think that the articles like the CNBC article that I mentioned a moment ago, I think you're going to see some curtailment of the ability of a lot of larger or heavily capitalized or publicly traded or all of those, their ability to capitalize on what Congress would have said the night they announced they had a deal, quote, small business relief. I think you're going to see some tightening in that regard. One suggestion I would make is that all the states are busted. They have a constitutional mandate to balance their budget. I don't know of any state that operates outside of a June 30th fiscal year. So right now, every state is doing everything they can to balance their budget for the budget cycle ended June 30, 2020. They haven't even begun to calculate the abyss that they will face for fiscal June 30, 2021. And all that translates to businesses, operating businesses, that you should be working with your accounting advisors, internal or external. You should be working with your tax advisors, internal and external, to make sure your tax function and your tax space is appropriately reacting to all these issues. For my brethren in the public accounting industry, their job right now in terms of valuing the impact of the tax changes for book accounting purposes is, I would venture to say, twice as difficult today, given everything that's occurred and will occur, than it was during the Trump Tax Act of Q4 and the magnitude of the changes that were made. And they had to immediately revalue all their tax assets and the deferred tax liabilities and the like in order to comply with the various accounting mandates. I can't imagine being an accountant working on that right now with the variability and the scope and the breadth and the level of changes that have occurred today. So those are some overview issues. I'll turn it back to Terry.
Thanks, Mark. This is Brad. So just as we pivot into kind of Q&A, we've got plenty of time here for some Q&A. So hopefully we'll get some good interaction from the audience. Just as a reminder, either drop a question into the chat or raise your hand and Terry will acknowledge you. And maybe to kick it off, Darren, this one's going to come to you. Melody's got a question. She wants to maybe get a little more insight as how do you see this EBITDA looking like and kind of where's that going to take us? So I'll kick it to you to give us some thoughts more on that.
Yeah, I think it's going to it's probably going to take a little time for it to ferret out, for lack of a better term, on exactly what add backs people are going to approve. But I liken it to a PE deal where a bank or a PE firm will look at what the acquisition costs were, if they're cutting out compensation, if they're closing and consolidating, those types of expenses that I think we can point to closing your doors on March 15th or whatever dates they were in the quarter. and saying there's expenses here that aren't in the normal run rate, and it's going to get added back to what I'm going to call EBITDA. So I think that's a term people are going to get more and more comfortable with as they start looking forward to what kind of debt capacity is here. You know, the whole, from a commercial lender standpoint, the whole covenant violation world, second, third, and fourth quarter this year is going to be very interesting.
All right. I know each of you, Ken and Darren, you both kind of acknowledge that you believe things will come back. Neither one of you really went out on that limb to say when it might come back. But Kim, why don't you give us some perspective, from your seat of, what do you see the rest of 2020 from PE perspective? Is that more really focused on the portfolio companies in 2020, and then 2021 is where transactions start coming back? Or give us some more insights from your seat.
Yeah, like I said, I think the activity in 2020 is likely to be more add-on acquisitions. So for existing portfolio companies looking for tuck-in acquisitions that we can do. New platforms, as it were, usually require building a capital structure with layers of debt. As long as creditors are on the sidelines or feeling skittish, it's going to slow that process, lower pricing. So from a deal market perspective, I think it's going to come back along with the economy and the confidence in the economy, and so I don't need to predict when that. I mean, no one can predict when that part's going to happen.
Right.
But we all hope it happens soon. The other thing that gives me optimism or hope is that there's still $1 trillion of cash overhanging the private equity industry. So there's still a lot of money that needs to be put to work. It's on a timetable, so every year we lose is a big chunk out of the time frame for that fund. So a lot of money still has to go out the door. So there's a strong impetus to getting deals done, but we're in the business of handicapping risk, and right now every horse is 50 to 1. To use a Kentucky youth analogy, I guess. I don't know how else to put it, but I think things will come back into focus quickly. I get a sense that people don't want to sit at home any longer. They're going to go back to restaurants. They're going to go back to bars and movie theaters and all that. Certainly, as we get vaccines and therapies developed, that will speed the confidence along. But really, we're talking about getting confidence and to come along first, and then once the confidence comes along, the economy will follow suit.
Mark, maybe going back to you a little bit, you talked about some of the things that have already come out from new tax law. Seems like every other day the president has some new favorite tax provision that he's supporting or promoting. Any views of those that he's kind of thrown out there and none stuck on the wall yet that might stick in the next maybe phase 4, phase 5, phase whatever phases we get to in the stimulus process?
Well, you're right in terms of phase 4, 5, 6, ad infinitum. To my comment earlier, I think we're going to see a series of regulatory first and then legislative second. At the federal level, it'll be more legislative than regulatory. But we're going to see a series of these over the next 3 or 4 months, because if you think about it, tax legislation is probably the last tool in the federal toolkit right now. With the way that the Treasury and the Fed came forward, one, in scope and scale, but two, in expedience, how quickly they moved to the firing line to stem the various problems, whether it be unemployment, whether it be liquidity, backstopping, other loans, whatever it be. There's only so many tricks left, right? They spent half the U.S. Budget in one bill, $2 trillion. So I think you will see a continued change in the tax. What's it going to look like? It could be very, very granular. One thing that's been kicked around recently is bringing back the full deductibility of meals, business, and entertainment expenses. Right? We haven't had full deductibility of T&E for, I don't know, 20 years or maybe even longer. I mean, it was so long ago. I think the last time it was, I was in law school learning that you could actually deduct, taking clients to lunch and buying them drinks, right? But I think you'll see something along those lines. You're also, the one good news is that the amount of regulatory relaxation that the IRS has pushed out is unprecedented. I mean, unprecedented. They have relaxed every administrative rule they can think of when pushing out their various notices to make things easier for taxpayers. Example, refund claims and amended tax returns and original tax returns can't be filed by email or fax, right? That's just the way it is. It's always been that way with the federal government. They've completely relaxed all those rules, opened up dedicated fax lines for certain filings, or giving kind of a wink that you can email things to the IRS. They're the last beast in the world that doesn't email with any regularity. It's the Internal Revenue Service for taxpayer confidentiality purposes. So I think you're going to see a ton more of administrative relaxations. But I also think, with the coming political judgment day in November, right? We're going to be 6 or 7 months into a recovery. Hopefully, if we start May 1 or June 1, we'll be 5 months into it by election day. And then it's a 50-50 toss. If you believe the rhetoric that's coming out from one side, there'll be tax cuts and tax accommodations. And if you listen to the rhetoric coming out from the other side, there's going to be tax increases, and there's going to be so-called big business takeaway. Again, Brad, maybe tax is cool again. I don't know. I'm going to wait.
Yeah, let's not go that far. So Darren, let's come back to you. I mean, probably the centerpiece of the last phase, whatever phase that was, is the PPP loan. It's gotten the most attention. It's gotten the most press. It's continuing to get press, and that's probably going to accelerate, not decelerate. You all just probably caught your breath from round one. Probably within 48 hours, you're going to be in round two. Any additional insights, learnings that you all had from a bank that as you go into round two of the PPP process that you see playing differently now?
Well, fundamentally, keep in mind whenever you're dealing with, say, the SBA, anything you can substantiate with a third party, which was normally the 941 reports, a payroll company providing you group health benefits, that kind of stuff. When it came to filling out that information, and then almost hand feeding that, because we have to hand feed it to the SBA. So if there's a column there for total payroll, and it sums 4 or 5 different columns or 4 or 5 different issues, you got to go into the spreadsheet, make sure that's laid out. So I think there were a lot of people that, again, to Mark's point, we were making rules up as we went. So we were playing and going and trying to get these in, and just worried that cash is going to run out, which it did. Clients were very sensitive to that. So working weekends and getting responses back from clients all weekends was the norm, frankly. And I think there'll be a little more calm in this 200 billion, if that's what it ends up being, in that a lot of people have gotten it. That number that didn't is smaller, and we kind of have a feel for what the rules are. The question might be, and I haven't gotten my hands around other programs that may come out for companies over 500 employees who still have real issues out there that need to be contemplated. So we learned a lot. I think the next onslaught really for all this will be the forgiveness calculations, and I think a lot of us will get busy and learn what exactly will be forgiven. And the other critical point I'll make is this is 8 weeks of payroll. They started this program in early April. By the end of May, it's kind of been spent. So if we don't, not that I'm a proponent either way because I'm not a doctor, but if we don't start opening up by June 1, I'm not sure we can we as a country can afford another 2 trillion to give us another 8 weeks. So it's a Band-Aid. The other comment I'd make, Brad, when we start talking about, kind of deal flow and how this thing comes out, if I look personally at my portfolio, there are haves and there are have-nots. There are companies who've done quite well and have managed through this, whether they're construction companies or whether they were in healthcare or other places that didn't really or haven't really missed too many beats. And then there are others who've been beaten up pretty bad. I have a client that owns cinemas, and they're shut down. They're not sure when they can open. So um, it's going to be interesting. It's really going to be interesting, and I think the sooner we can start the process of opening, I think it makes everybody feel better. As long as we can keep those spikes down, and that's probably the most important thing over the next 2 weeks is to get a plan in place and monitor it to see if we can get there.
Let's stay with you, Darren. A question just came in about the Main Street Lending Program. Any insights on that you could share to the group?
Yeah, I wish I had more. We've been spending so much time on PPP that I haven't. I'm not even a bad expert. I don't have enough data really to give
That's fair.
to give thoughts on it yet. It's there'll be several waves of these types of programs, and I think the Main Street was really for the over 500 up to 10,000. But I can't give you insight yet. I apologize.
No, fair enough. Ken, I'll come to you with this next question. It just popped up in the chat, and that's obviously our educational system at all levels has been greatly impacted. What's your view of that and how that might impact the economy overall?
You're talking about high school and college educations?
Yeah, it could be any of those, right? Because at every level, it's been dramatically impacted, and whether it's higher ed or whether it's high schools, or you pick a level and tell me what you think the impact is.
Well, I have a junior in college right now, as a matter of fact. So she's been home for the second half of her second semester, and we're still hopeful that she is going to go back in the fall. No word on that yet. But she's doing online learning at the house. A lot of it is Zoom based, just like this call right here. So I believe it's fairly effective in terms of educating people, but it's certainly not the same experience as being on campus and interacting with your classmates and your professors, and that whole growth and learning experience that you get. A bigger impact on our companies, though, perhaps, is that for younger kids in school, that becomes the daycare for those kids and for those families. And with the kids at home, we now have employees that are not able to come to work because they can't find sitters for their kids. So that, I think, is probably the biggest single impact on businesses with respect to the school shutdowns. And that's a real problem.
Mark, I know when we were doing the kickoff, you were talking about you were impacted at your house with the impact of higher education with the daughter in law school and probably others based on the number of people you said that were at the house. So your views on this subject?
It's an interesting dynamic, right? I actually have 3 students. One, my youngest, just graduated undergrad in economics in December and is waiting to assume her position out in Silicon Valley July 1. We hope, fingers crossed, right? So that's one dynamic I've got going on. She was actually in Europe for a 7-week trip right when all this happened, and we were very fortunate to pull her out of Paris literally at 12:15 the day that Macron shut the borders at 12 that day. And then I have a first-year law student who has been in the basement for 5 weeks, taking classes on the Socratic method via video, which I still can't wrap my hands around. I would snoop and sit around her and try to watch how it worked, but she's certainly not getting the typical first-year law school effect, right? Which is walking into class every day with, feeling terror and dread, which would motivate you to prepare. And then my middle child is finishing up a master's at U of L, and doing it all remotely. So we've got all types, and I see the stress in their approach. I worry about the long-term impact on these students. Everything's pass-fail now.
Yeah. I'd add one thing, Brad, and that is internships are at risk this summer. That's going to be a major impact on students. And then, of course, anybody graduating coming into a workforce that's shut down, I don't know how you would find a job in the near term. So those are two also very important factors to consider if you're a school age person.
And Darren, I'll give you any final thoughts in this space, because I know you've got two that are dealing with this as well. So any additional thoughts?
Yeah, one actually works for Trinity High School, and they've been fairly steady in that because they have online classes. Their administrative group has been working pretty hard. The other is actually in Florida at school. And to both Mark and Ken's points, the online, my sense of what she has gone through down there is that a lot of, I won't call it busy work, but a lot of work has been thrown out there to make sure the kids are busy and absorbing the data. It'll be interesting to see how well they do with all that. We all do online classes. I'm pretty much old school, and to Mark's point, like that fear of walking into a class and getting questions asked of me kept me on my toes. But overall, I think the online has some capacity. I just don't think it should take over that college experience. I would say I learned as much being around 30 or 40,000 other college kids my age at Indiana to learn how to get basketball tickets before everybody else, or get a class, or work through class when some people aren't, and living through a fraternity, etc. Those social experiences can't be replaced online.
Yeah, I agree. So maybe with the interest of time, I'm gonna go back through each of the panel members just for asking you for any final thoughts, comments. So Ken, I'll let you started us, so I'll let you start off the final comments.
Yeah, I'm glad you came back. One of the things that I've been thinking a lot about is what the new normal is going to look like. And I think we all can imagine that there's going to be a considerable shift in our economy in the future. There's going to be more onshoring of work. We've outsourced an awful lot of our country's capability over the last 30 and 40 years. There's clearly going to be an impetus to bring manufacturing back, particularly when it comes to drugs, electronic technologies, and other things that are in kind of a national security interest, whether it's swabs or ventilators or whatever. There's going to be a whole new focus on onshoring stuff back to America for our national security's sake. And so I think that's an impact that hasn't been written a lot about, but I think that when we get through this and the economy starts to open back up, that'll be part of the new normal trend.
All right, thanks. Mark, parting comments?
Yeah, I do. Two points. I do urge everyone to keep in mind, communicating with your elected representatives. I think this is a real opportunity for business people, big and small business, to reach out and talk to their elected officials. And I think more now than ever before, they are listening and they want to hear from you, because they are literally blowing in the wind just like everyone else, right? Which way is the direction going? I think it's an opportunity for you to leverage relationships in business that can only come back and help you later on. But to follow up on Ken's point, I think that going forward, in conjunction with this onshoring, in conjunction with this American ideal of bringing back certain industries and/or protecting ourselves, whether it be from safety or national defense or national security paradigm, I think you're going to see economic incentive and economic development competitiveness from locale to locale, state to state, like I've never seen in my career. I've seen some really, really aggressive deal work in terms of states bidding for new work. I think this is going to be that on an accelerant. So translation, if you happen to be in one of those growth businesses, or you happen to be in one of those businesses where you need some incentive because you're making a major investment of CapEx, whether it's an acquisition in the PE space or just an expansion, you've got the cards, or you will have the cards when the economy starts to turn. Keep that in mind.
And Darren, final comments?
Yeah, two comments. One, adaptation. I think technology, just what we're doing today, you better get on that bandwagon, and you better be pretty efficient at it if you're going to get ahead going forward. I think that's become more and more important. Working smart, being technologically advanced enough to get in front of people, whether you can do it. If we're not able to do it so much, I think travel, so forth, is gonna wane. So you're going to have to find ways to develop strong relationships, and so I say adaptation. And secondly, I think at least on the banking side with clients, we learned, if I draw, say, a 100-mile circle around Louisville, Kentucky, that relationships are important in trying to get something done in a crisis standpoint. And the more you've worked with somebody or know somebody, and they have a pretty good feel for what your company is like and so forth, the more the better the ability I think you had to work and make something happen in exactly in the PPP program, whether it's that or the next things coming out. So adaptation to what we're going to do going forward, and strengthen those relationships, I think, are my two kind of keys going forward for the next 100 days.
Perfect. Well, special thanks to Ken, Mark, and Darren for joining us and sharing their thoughts and answering some questions from the audience. Hopefully everyone's got some takeaways from today. I appreciate everybody joining us for our first ever virtual event. A couple of reminders before we part ways here. May 12th, be on the lookout. 1 to 2 is probably what we'll confirm, but we'll send out a notice so that can get on your calendar. But hopefully you've already got that date, and we'll just adjust the time. More to come on Mid-South Capital. Again, we're hopeful that we can still have something in the fall of 2020, but it's just unknown. But we're also extremely hopeful that our August event, which always is a great kickoff to the new chapter year, with Darren's hosted golf event, that's still on the calendar, and we're hopeful that that'll be a way to celebrate the end of the summer and kicking off the fall. I think most people will be looking forward to those days. Even as hot as it was last year, Darren, I think people would take that today versus where we're at. So special thanks to Terry for hosting and coordinating all the events kind of behind the curtain. And we look forward to seeing this group back on May 12th. Everybody stay safe and healthy, and we'll see you in a couple of weeks.
Thank you, Brad.
All right, thank you.
Thanks all.